Whether planning for retirement or just trying to earn some additional cash, investing can stand a fantastic path to increase your finances. But with so many options, figuring out where to start can take time. That's why I'm here to share with you 5 simple rules for investing as a beginner. Rule number 1, invest in what you know. Investing can be a daunting task, especially for beginners. There's a lot of jargon, complex financials, and the added pressure of making the right decisions to grow your wealth. But what if I told you there's a simple rule to help you invest confidently? That's right. Warren Buffett, one of the most successful investors of all time, advises us to invest in what we know. It means financing businesses and initiatives we're familiar with. For example, if you work in the technology industry, you may better understand the trends and possible development opportunities in that sector. This knowledge can help you make informed investment judgments and minimize the risk of costly mistakes.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now.
Investing in what we know also means understanding the fundamentals of the businesses we're investing in. Before making investment decisions, it's crucial to research and understand the company's business model, competitive advantages, and financials. This knowledge will help you make informed investment conclusions and bypass highest judgments based on fleeting market trends and speculation. Think of it this way. Would you buy a car without knowing how it runs? Of course not. The same goes for investing. You only want to invest your hard-earned money in a company or industry you understand. By investing in what we know, we can feel confident in our investment decisions and minimize the risk of making costly mistakes. Warren Buffett himself has applied this rule throughout his career. He famously invested in Coca-Cola because he believed in the company's products and long-term growth potential. He also invested in Geico because he understood the insurance business and saw potential growth. Buffett's success is a testament to the force of investing in what you know. Investing in what we know doesn't mean limiting ourselves to only investing in our industries. We should have a good understanding of the businesses and initiatives we're investing in. Doing so lets us make informed investment decisions and feel confident in our investment strategies. It's a simple yet powerful rule that can help us confidently support ourselves. By researching and understanding the fundamentals of the businesses and initiatives we're investing in, we can minimize the risk of making costly mistakes and maximize our chances of success. So the next time you consider an investment opportunity, ask yourself, do I understand this company and industry? If the answer is yes, then you may be on the right track to success.
That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. But the biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission.
Rule number 2, don't time the market. Timing the market can be a tempting strategy for investors. After all, who wouldn't want to buy stocks at their lowest point and sell them when they reach their peak? However, the reality is that timing the market is a risky game, and it's one that the most seasoned investors can't play with certainty. The stock market is notoriously volatile and inconsistent. Many factors, including geopolitical circumstances, financial data releases, and social media trends, can influence its movements. Trying to time the market established on these factors is like predicting the weather by looking at the clouds. The danger of timing the market is that it often leads to making emotional decisions based on fear and greed. Investors may need more time to buy stocks when the demand increases. Conversely, investors may panic and sell their stores when the market is going down, even if they're undervalued. This behavior can lead to a phenomenon known as herd mentality, where investors follow the crowd rather than thinking for themselves. The consequences of herd mentality can be devastating. It can lead to a situation where the market becomes overvalued or undervalued, and investors buy high and sell low. It is the opposite of what you want to do when investing. Instead of trying to time the market, focus on the long term and aim to hold your investments for as long as possible. When you invest for the long term, you give your assets time to grow and compound. Compounding refers to earning returns on your initial investments and the returns generated over time. Rule number 3, diversify your portfolio. Diversification is the key to managing risk in investing. Warren Buffett advises us to put only some of our eggs in one basket. By diversifying our portfolio, we spread our risk across multiple assets, which helps to minimize the impact of any one investment's performance. Warren Buffett famously said, "Diversification is protection against ignorance."
Knowing how to diversify well is more important than almost anything. People don't understand this. So that margin, so I can reduce my risk without reducing my return by knowing how to diversify. And I'd say that's particularly important for the people who are listening, your investors.
My friend Emily was a young investor, eager to grow her wealth and secure her financial future. She had saved a significant amount of money and was ready to invest. Emily knew investing in just one asset or company could be risky, so she diversified her portfolio across various assets and industries. She invested in stocks and bonds and even purchased a few pieces of real estate. She carefully researched each investment opportunity and made informed decisions, confident in her choices. As time passed, Emily's portfolio began to grow steadily, and she felt more and more secure about her financial future. Rule number 4, invest for the long term. When you invest in a company, you're not just buying a piece of that company. You're also investing in its future growth potential, earnings, and dividends. Over time, as the company grows and expands, its earnings and dividends may increase. As a shareholder, you'll benefit from this growth through the accumulation in the worth of your investment. But it's not just the increase in the value of your investment that matters. It's also the power of compounding retrievals. Compounding retrievals guide to making recoveries on your initial investment and the returns generated over time. Let's say you invest $1,000 in a stock with an annual return of 8%. After 1 year, your investment would be worth $1,080. After 2 years, it would be worth $1,166.40. After 3 years, it would be worth $1,259.71, and after 10 years, it would be worth $2,159.14.
It's nice to have 4% in real terms, but 2.5%, it may be slow in getting us out from the slump that we entered into a few years ago, but it's a remarkable rate of growth. And it's something that's doable. I mean, the culture is stronger now than it was 10 years ago, and it was stronger then than 10 years previously. It moves slowly, but it goes in the right direction. We wanted them all to be compounding, in effect, be compounding machines.
That's more than double your initial investment thanks to the power of compounding returns, which is why long-term investing is so significant. The longer you bear on your assets, the more time they have to grow and benefit from the power of compounding returns. Even small returns can add up over time, so it's essential to be stoic and disciplined. Financing for the long term also helps us to avoid making emotional decisions based on short-term market movements. The stock call can be incredibly volatile, with daily fluctuations and erratic swings. It's easy to get caught up in the moment and make hasty decisions based on fear or greed. But if you're financing long-term, you can ride out these short-term fluctuations and focus on the bigger picture. Rule number 5, keep your emotions in check. Emotions are a natural part of being human. We all experience them. However, when investing, emotions can be a double-edged sword. On the one hand, emotions can motivate us to invest in the first place. We might feel excited about the potential or high returns, or the thrill of the stock market. However, emotions can also cloud our judgment and lead us to make decisions based on fear or greed. Anxiety can cause us to sell our investments when the market drops, even though that might not be the best decision in the long run.
You don't need a lot of brains in this business. I mean, I've always said if you got an IQ of 160, give away 30 points to somebody else because you don't need it in investments. What you do need is emotional stability. You have to be able to think independently, and you have to be when you come to a conclusion, you have to really not care what other people say and just follow the facts and follow your reasoning. And that's tough for a lot of people. That part I think I was just lucky with. I was born that way.
Desire can lead us to invest more money than we're comfortable with, chasing higher returns and potentially exposing us to more risk than we can handle. Warren Buffett is well known for his ability to keep his emotions in check when investing. He said, "In the business world, the most successful people are rational and logical rather than emotional." So how can we keep our emotions in check when investing? One way is to have a clear investment plan and stick to it. This plan should include our investment goals, risk tolerance, and diversification strategy. There you have it, folks. Those are the 5 simple rules inspired by Warren Buffett that will help you get started on your investing journey. Investing can be daunting, but it doesn't have to be. Following these rules can minimize your risk and maximize your returns. Investing is a long-term game, and one must own tolerance and discipline. Don't try to time the market, and don't let your emotions get the best of you. Invest in what you know, diversify your portfolio, and aim to hold on to your investments for as long as possible. I hope you found this video helpful. Hit that subscribe button, smash the like button, and share this video with your friends and family. Your comments are also highly appreciated, so leave one below and let me know what you think. And remember to check out the following video on the end screen for even more valuable tips and tricks. Thank you for watching.